Life insurance isn't just protection, it's a wealth-building tool. Here's how to use it right. Most people think life insurance is only for replacing income if you die. But when structured correctly, life insurance creates instant generational wealth, provides tax-free inheritance, and protects your family's financial future. The key is choosing the right type and using it strategically. Today, I'm breaking down the types of life insurance, which ones build wealth, which ones don't, and the exact strategies families use to create multi-generational legacies. Why life insurance matters for generational wealth. Life insurance serves two critical purposes: protection. If you die unexpectedly, your family receives a tax-free death benefit that replaces your income, pays off debts, funds education, and maintains their standard of living. Wealth transfer. Life insurance provides an instant estate. Even if you haven't built significant assets yet, a life insurance policy creates immediate generational wealth the moment you die. Here's the power. A 35-year-old paying $70 per month for a $1 million term policy creates instant generational wealth if they die. That $1 million is tax-free, liquid, and available to the family immediately. Without life insurance, your family gets whatever assets you've accumulated minus debts, taxes, and probate costs. With life insurance, they get a guaranteed payout that changes their financial trajectory. Term life insurance. Protection without wealth accumulation. Term life insurance is pure protection. You pay a premium for a set period, 10, 20, or 30 years. And if you die during that term, your beneficiaries receive the death benefit. If you don't die, the policy expires worthless. Pros: affordable. Term life is the cheapest form of life insurance. A healthy 35-year-old can get a $1 million 20-year term policy for $50 to $70 per month. Simple. No cash value, no investment component, no complexity. You pay premiums, and if you die, your family gets paid. High coverage. Because it's cheap, you can afford more coverage. This is critical when you're young with kids and a mortgage. Cons: no cash value. Term life doesn't build wealth. You're renting coverage. When the term ends, you get nothing back. Expires. If you outlive the term, the policy ends. You can renew, but premiums skyrocket as you age. Not permanent. If you want lifelong coverage, term life won't work. When to use term life. Term life is perfect for young families building wealth. You need high coverage to protect your family while you're accumulating assets. Once your kids are grown, your mortgage is paid, and you have significant savings, you may not need life insurance anymore. The strategy: buy term life insurance and invest the difference. Instead of paying for expensive permanent insurance, buy cheap term coverage and invest the money you save into retirement accounts and brokerage accounts. Over time, your investments become your family's financial safety net, and you can let the term policy expire. For a proven framework on protecting your family and building wealth simultaneously, check out the Total Money Makeover. It walks you through insurance, investing, and wealth building. Links in the description. Whole life insurance. Permanent coverage with cash value. Whole life insurance is permanent. As long as you pay premiums, the policy stays in force for your entire life. It also has a cash value component that grows over time. How it works: you pay a fixed premium. Part of that premium goes toward the death benefit. The rest goes into a cash value account that grows at a guaranteed rate, usually 2 to 4% per year. You can borrow against the cash value or withdraw it while you're alive. Pros: permanent coverage. The policy never expires as long as you pay premiums. Your family is guaranteed a payout when you die. Cash value growth. The cash value grows tax-deferred. You can borrow against it for emergencies, business opportunities, or retirement income. Guaranteed death benefit. Your beneficiaries will receive the death benefit no matter when you die. Cons: expensive. Whole life premiums are 10 to 15 times higher than term life. A policy that costs $70 per month as term might cost $800 per month as whole life. Low returns. The cash value grows at 2 to 4%, which is terrible compared to stock market returns of 10%. Complexity. Whole life policies are loaded with fees, commissions, and fine print. Many people don't understand what they're buying. When whole life makes sense. Whole life works for high net worth individuals who have maxed out all other tax-advantaged accounts and need additional estate planning tools. It's also used for business succession planning and creating tax-free legacies. For the average person, whole life is expensive and unnecessary. You're better off buying term life and investing the premium difference in index funds. Universal life and variable life. Flexible and risky universal life and variable life are variations of permanent insurance with flexible premiums and investment components. Universal life lets you adjust premiums and death benefits. The cash value grows based on market interest rates. Variable life lets you invest the cash value in sub-accounts similar to mutual funds. Returns vary based on market performance, which means higher potential growth but also higher risk. The problem: these policies are complex, expensive, and often underperform. The fees eat into returns, and if the market performs poorly, your cash value shrinks. Many people end up paying more in premiums than they expected or letting the policy lapse. Unless you're working with a highly experienced financial advisor and you have specific estate planning needs, avoid these. The wealth building strategy. Term life plus investing. Here's the strategy that works for most families. Step 1. Buy term life insurance for 10 to 12 times your annual income. If you earn $60,000 per year, buy a $600,000 to $720,000 term policy. If you earn $100,000, buy a $1 million to $1.2 million policy. This ensures your family can replace your income, pay off debts, and maintain their lifestyle if you die. Step 2. Choose a term length that covers your highest risk years. If you have young kids and a mortgage, buy a 20 or 30-year term. By the time the term ends, your kids will be grown, your mortgage will be paid, and you'll have significant assets. Step 3. Invest the difference. The difference between a term premium and a whole life premium is significant. If term costs $70 per month and whole life costs $800, that's $730 per month you can invest. Invest that $730 in a Roth IRA and a brokerage account. At 10% annual returns over 30 years, that's over $1.6 million in wealth you've built. Your investments become your family's financial safety net. You don't need permanent life insurance because you're self-insured through your portfolio. For a deep dive into investing strategies that build long-term wealth, read Money, Master the Game by Tony Robbins. It breaks down how to structure your finances for maximum growth. Links in the description. Life insurance for estate planning. If you're building significant wealth, over $1 million in assets, life insurance becomes an estate planning tool. Strategy 1. Cover estate taxes. If your estate exceeds the federal estate tax exemption over $13 million for individuals as of 2024, your heirs will owe estate taxes. Life insurance provides liquidity to pay those taxes without forcing your family to sell assets. Strategy 2. Equalize inheritance. If you own a business or real estate that you're leaving to one child, life insurance can equalize the inheritance for your other children. One child gets the business. The others get the life insurance payout. Strategy 3. Create a tax-free legacy. Life insurance death benefits are tax-free to beneficiaries. If you want to leave a large, tax-free inheritance, life insurance is one of the most efficient vehicles. Irrevocable life insurance trusts, ILITs, For estate planning, wealthy families use ILITs. You transfer ownership of a life insurance policy to an irrevocable trust. The trust owns the policy, pays the premiums, and receives the death benefit. Because you don't own the policy, it's excluded from your taxable estate. This is advanced planning and requires an estate attorney, but it's a powerful tool for preserving wealth across generations. For a comprehensive guide to trusts and estate planning, read the only living trusts book you'll ever need. It covers how to protect and transfer wealth. Links in the description. How much life insurance do you need? If you have dependents, 10 to 12 times your annual income. If you earn $70,000, that's $700,000 to $840,000 in coverage. If you're single with no dependents, you might not need life insurance unless you have debts that would burden your family, like cosign loans, or you want to leave an inheritance. If you're retired with significant assets, you probably don't need life insurance unless it's for estate planning purposes. The goal is to ensure your family can maintain their lifestyle, pay off debts, and cover expenses without financial hardship. Your next move if you don't have life insurance and you have dependents, get quotes this week. Use an independent broker or online comparison tools like Policygenius or SelectQuote. Compare term life policies from multiple carriers. Get coverage equal to 10 to 12 times your annual income. Lock in a 20 or 30-year term. Pay the premium and move on with life knowing your family is protected. If you already have whole life or universal life, review the policy. Calculate what you're paying versus what you'd pay for term. If you're overpaying, consider converting to term and investing the difference. Life insurance is a tool. Use it to protect your family, create instant generational wealth, and ensure that no matter what happens, your loved ones are taken care of. That's wealth mode. If this video was helpful, please click the subscribe button and then like and share with your family and friends.